How to use supply and demand in trading. Welcome to this comprehensive guide on using supply and demand in trading. Whether you're a complete beginner or an experienced trader looking to sharpen your skills, understanding this concept could be the pivotal change in your trading journey. Today, we're diving into how to identify supply and demand zones, use them strategically, and gain an edge in the markets. By the end of this video, you'll have actionable tools to improve your entries, minimize risk, and really understand the psychology driving market behavior. Let's dive right in. At its core, supply and demand are the forces that drive markets. They determine whether prices rise, fall, or remain in a tight range. Here's the simple breakdown. Supply refers to sellers in the market. When supply increases, prices tend to fall because there's more selling pressure. Demand represents the buyers. When demand grows stronger, prices often rise because of increased buying activity. The beauty of understanding supply and demand is it gives us insight into why markets move. When there are more buyers than sellers at a particular price, demand pushes prices up. Conversely, when there are more sellers than buyers, supply drags prices down. For traders like you, this knowledge is invaluable. Why? Because these forces don't just appear randomly, they cluster in certain zones on the price chart. That means you can identify key levels where buyers or sellers are likely to take action. Stick around, and we'll show you how to drill into these zones and use them strategically. Supply and demand zones are regions on a chart where prices have historically shown strong reactions. A supply zone is an area where prices move down significantly, indicating heavy selling pressure. A demand zone is an area where prices moved up sharply, revealing strong buying interest. Think of these zones as real battlefields between buyers and sellers. Here's why they're respected by traders. History repeats itself. Markets have memory, and these zones often act as magnets for price action when revisited. In simple terms, supply zones often signal where prices might slow down or reverse. Demand zones, on the other hand, suggest where buying opportunities might arise. Now, let's move on to the key part: how to spot them on a chart. Here's where things get fun and visual. Identifying supply and demand zones is the first step in leveraging them to your advantage. Follow these simple steps. Look for strong price movements. One of the easiest ways to find a supply or demand zone is to identify moments on the chart where prices move away quickly from a specific level. These sharp movements often indicate an imbalance between buyers and sellers. Notice consolidation patterns. Before a strong price move, there's often a period of consolidation. This is where prices move in a tight range before breaking out. The consolidation area usually marks the starting point of a supply or demand zone. Edges of the zones. Draw the zones around the consolidation area. For demand zones, focus on the lowest point in that range. For supply zones, emphasize the highest point. Volume clues. Big movements with significant volume reinforce the importance of these zones. High volume suggests strong institutional activity. If you're seeing substantial interest at certain levels, those are probably important zones. Don't worry if this process feels tricky at first. With practice, your ability to spot these zones will improve. Start with major areas, and as you gain confidence, you'll naturally fine-tune your eyes for even smaller zones. Once you've identified supply and demand zones, it's time to put them into action. Here's how you can use these zones in your strategy. Entering trades at demand zones. When prices approach a demand zone during an uptrend, it signals potential buyer interest. For example, wait for prices to touch the zone, confirm bullish momentum, like a candlestick pattern or strong rejection, and then enter the trade. Selling or shorting at supply zones. Supply zones act as resistance areas. If prices rally into a supply zone during a downtrend, that's your signal to watch for bearish confirmation and plan an exit or short trade. Let's simplify it further. In an uptrend, demand zones are your buying points. In a downtrend, supply zones are your selling points. You're not trying to predict markets. You're reacting to what's happening at these key levels. The goal is to use supply and demand to stack the odds in your favor. Why do these zones even work? A huge part of it is psychology. Let me explain. Why demand zones work. When prices sharply rally from a demand zone, they indicate strong buying interest. Often, large institutions place bulk orders at these levels, but not all orders are executed at once. When prices revisit the area, those leftover orders kick in again, creating a similar buying reaction. Why supply zones work. The same is true for supply zones. When sellers dominate, they leave behind unfulfilled sell orders. As prices re-enter a supply zone, those orders are triggered, fueling downward momentum. This psychological pattern is why traders respect these zones. They reveal the underlying intention of major players in the markets, the institutions, hedge funds, and professional traders who truly drive price movements. By understanding and respecting these zones, you're aligning your trades with the big money. No strategy is complete without risk management, especially when day trading. Here's how supply and demand zones help you keep risks in check. Set stop loss right outside the zone. Say you're buying at a demand zone. Place your stop loss slightly below the bottom of the zone. For supply zones, place a stop loss slightly above its top. This ensures you're out of the trade if the market breaks beyond anticipated levels. Target opposite zones for profit. Your profit targets can often be set at the next major supply or demand zone. For example, if you buy at a demand zone, aim to sell when prices near the nearest supply zone. Protecting against false breakouts. Sometimes prices temporarily breach a zone and then reverse direction. This is called a false breakout. Give your stop loss a small buffer to avoid exiting prematurely. By managing risk effectively, you'll protect yourself from significant losses while maximizing rewards when trades go your way. Traders often get excited about supply and demand, but errors can creep in. Let's address some of the most common mistakes. Misidentifying weak zones. Not all price movements indicate a strong supply or demand zone. Look for significant price reactions paired with high volume to confirm the zone's importance. Ignoring market context. Don't focus on zones in isolation. Always consider the broader trend. For example, trying to short in an aggressive uptrend because of a supply zone is risky unless you have clear confirmation. Overlooking confluence. Combine supply and demand with other confirmation tools like moving averages, RSI, or candlestick patterns. Zones reinforced by multiple factors are more reliable. Awareness of these pitfalls ensures you approach trading with discipline and precision. Want to truly master supply and demand? Stick to these best practices. Backtest your strategy. Use historical data to validate how well supply and demand zones work within your trading system. Look for repeated patterns before committing real capital. Start small. Practice trading these zones on a demo account. This will help you refine your execution without financial risk. Refine through observation. Noticing how price behaves at specific levels improves over time. Review charts daily to sharpen your instincts. Combine techniques. Supply and demand aren't standalone strategies. Pair them with concepts like trend lines or support resistance for more robust decision-making. By staying consistent with these habits, you'll gradually build confidence, precision, and success in your trading game. To wrap things up, mastering supply and demand isn't about finding a secret indicator. It's about understanding how markets work. These zones represent areas where big decisions are made by institutions and traders alike. By learning to identify, apply, and manage risk around these zones, you're setting yourself up for smarter, more profitable trades. Remember, it takes practice to see results. Take what you've learned today, apply it, and keep refining. The market doesn't reward guesswork, it rewards preparation. We hope you found this video insightful and actionable. If you're looking to enhance your skills further, make sure to subscribe and check out our other videos for more trading strategies geared towards day traders. Until next time, trade wisely and stay disciplined.